Is PTT's strategy to become a multi-industry conglomerate the right move? Welcome to the Valuation Master Class case study, where you're going to learn about interesting stocks and how to value them. What's interesting about PTT is that its revenue makes up 10% of Thailand's GDP. Whoa, that's huge. This is Andrew Stotz of Valuation Master Class. Let's get started. Before we go into it, remember the information is for learning purposes only. It's not investment advice, or I'm not giving you a recommendation in this. Let's look at the company, PTT. It's a state-owned, Thailand-based giant engaged in petroleum and gas business. It's ranked among one of the world's largest 200 companies. So the question is PTT's strategy to become a multi-industry conglomerate the right move? There's three things you should know about this company. First, expansion to other industries as oil business matures. Second, natural gas as a transition fuel drives PTT's organic growth. And the third is attractive dividend yield despite the rise in invested capital. Let's look at a few key statistics. There's 21 analysts covering the company, and their target price is about 50 baht, a $32, 32% upside, and its price to book is about 1.2 and dividend yield of 2.6. My estimate of value is about 48. So it's pretty close to consensus. This is a company that is heavily covered. There's a lot of information out there. Also, as we go through this company's valuation, you'll notice that I'm looking at the company as a whole and using free cash flow as a measure of value. Sometimes we would value this type of company, a conglomerate, as a sum of the parts. But I'm not going to go through that. I'm going to keep it simple in my valuation. Let's look at sales first of the company. The revenue breakdown is 57% crude oil, 21% natural gas, 17% petrochemicals, and then power and utilities, another 7%. If we look at the share price, you can see it's been kind of trending down for the last 12 months or so. And over the past year, the price has been volatile, up and down quite considerably. Actually, it's gone from 34 low to a $42 high. Now, most recently, the 50-day moving average stayed below the 200-day moving average, which is a bearish signal right now. However, both lines have moved pretty close together since the beginning of the year. So it's not really have any major breakout happening, it looks like, right now. Now, the RSI is slightly above the 50% line and looks to be accelerating a bit. That could be good news overall that starts to drive the share price up a bit. Now, what's the story here? The story is expansion to other industries as oil business matures. Just looking at some of the subsidiaries and long-term investments that the company's made is pretty significant. A company, AI and Robotics Ventures, InnoBic, Rise, PTT Digital, and its new strategic alignment management with it. Management aims to tap into further industries to escape growth stagnation. This includes pharmaceuticals, nutrition, medical technology, AI, robotics, and all of these different areas. The company will allocate 32% of its future CapEx budget until 2030 to invest in new industries, mainly through M&A. Now, M&A is an interesting strategy for this company because obviously they're linked to the Thai government. They're huge, and they have the power of the Thai government and the power to borrow money very cheap. In fact, some people even argue that they have an unfair advantage in allowing a company that's connected to the government to compete in everyday business, like coffee shops, as an example, is really an anti-monopoly. It's a monopoly practice that really is risky for an economy. Generally, I would agree with that. You want to keep funding of government type of businesses into areas not necessarily where private businesses are competing. But let's look at the question about diversifying business lines. Sounds great, but is there any downside? The advantage of focusing on one single segment is that a company ends up allocating all its resources to maximize the returns out of that segment. Now, in the case of multiple business lines, investors are exposed to industries in which they may not want to invest. And then you buy this company, you have to own the other parts of this company. Now, investors can diversify themselves by simply adding stocks of other companies to their portfolio. So the question many investors would say is, why do I want to buy a company like PTT that owns other listed companies when I can just buy those listed companies on their own? Now, if a conglomerate owns mainly listed companies, usually the conglomerate will trade at a discount because of this, right? And so this is why there is a discount, because some people may say, I want to adjust my exposure to those different companies on my own, not through the conglomerate. And I have access through the market to do that. Now, if the conglomerate own only unlisted companies, you may say, well, I want to invest in this conglomerate because I believe they're going to get preferential opportunities to get into unlisted companies and bring them to the market. That's exposure I wouldn't be able to get. Now, that could be something that prevents a conglomerate from trading at a discount or even has it trading at a premium. Now, transition from mature to growth company requires high CapEx. In the context of its aggressive expansion plan, I expect a massive ramp up of CapEx. So basically what we can see is between 2016 and 2018, CapEx to depreciation ratio was about 1, meaning they weren't investing much more than what they needed to maintain the existing assets. This highlights the maturity status of the company. The ratio could grow, though, if they're going to be aggressively investing into these other industries. That ratio could grow to up to maybe 1.5 times, which is what I put into the forecast. Remember that CapEx is an important item in the calculation because it also impacts free cash flow to the firm. When your CapEx is rising, your initial free cash flow to the firm is falling because you're using that free cash flow for CapEx. But hopefully it's going to drive higher and higher and higher EBIT, or let's say operating profit, that's going to cause the free cash flow to the firm to rise. Now, let's look at point number 2. Natural gas as a transition fuel drives PTT's organic growth. I'm showing a chart here of the Thai demand for natural gas. This is in million standard cubic feet per day. And we can see that it did come up pretty substantially in the prior periods, but it's really leveled off in the last 5 years. PTT continues to expand its natural gas production, which already contributed about 21% in 2020. In 2021 versus about 14% in 2014. So natural gas is a key element of this business. It's likely to stay a dominant fuel in Thailand. Thailand does have good natural gas resources. Demand for natural gas sees a continuous growth in the future of about 2% per year. PTT plans to add a 6th gas pipeline and build a 2nd LNG terminal during 2022. Now, PTT also aims to become a dominant player in renewable energy. In 2021, PTT entered the renewable energy market with a capacity of 200 megawatts. This equals about 1.3% of Thailand's total renewable energy capacity of 15,000 megawatts. The company plans to allocate about 15% of its CapEx budget to expand its existing capacity to 12,000 megawatts by 2030. That might be a bit of an ambitious target, but it is worth going after, I think. Also, I expect the margin from this business to be lower than the oil and gas business. Now, I want to tell you a story. I remember many, many years ago, there was a parliamentary debate in Thailand, and what the opposition was blaming the government for was that the government was not paying out enough dividends out of PTT, a government entity. And basically, they were blaming them to say that you're disadvantaging the government by not getting cash out of PTT and getting it into the government. Now, the existing government at the time didn't really defend their move very well. If I was there, here's what I would have said. Wait a minute. Guys, remember, PTT has a return on invested capital of 40%. That means every dollar that we put into PTT, we're earning 40% on. If we take that money out and we give it to the government or we give it to the bank, we're going to earn 1%. We should be reinvesting these dividends at this very high rate of return while we can. Now, that is the logic of what should have happened, but that's not what happened. PTT had to continue to pay out more in dividends. But why is this an important story? Because the next chart I want to show you, and the next point in the story, is that attractive dividend yield despite the rise in invested capital. Now, here I have a return on invested capital in the chart, a chart of return on invested capital going back to 2017. You can see how long ago that debate was that I was talking about when the ROIC was 40%. Now the ROIC of PTT is 14% as of 2017, and now I'm expecting that it's going to bounce back in 2021 from basically being very low at about 4% in 2020, but that we're not going to be in a situation where the company is going to have a high ROIC like it used to have in the past. I expect PTT to return to an ROIC of about 10%. Now, the advantage for PTT is that they have a low cost of capital because they can use the government's backing to get low funding. So estimate of cost of capital is around 4 to 5, maybe 6% at the max. So ROIC is likely to decline over time as they invest heavily in these new projects that are less, they're more risky, basically. So dividend yield is attractive and could reach a comfortable 5% in 2022. Remember, you can scan this QR code if you're watching this video, and if you're listening to this, just go to valuationmasterclass.com, go to the blog to download the free case study reports for free. So let's talk about the FVMR scorecard for this company. We measure a stock's attractiveness relative to all other companies. Attractiveness is based on 4 elements: fundamentals, valuation, momentum, and risk. And we look at it on a scale from 1 to 10, 1 being best. So here we can see that we're looking at PTT relative to 460 non-financial companies in Thailand. And I would like to focus on the valuation. If we look in more detail in valuation, we can see that PE is about 12 times, price to book is about 1.1 times. This company is pretty darn cheap. And as a result, that's part of the reason why most analysts have a buy and why I think there's plenty of upside here. The price to revenue or price to sales is about 0.5. That's pretty low. It's never going to be super high, but I think that there's some value in this company right now. Now, recently I created a short online course explaining my FVMR investing approach. I usually sell it for $97, but for a limited time, I'm offering it for free. I have the link here. There'll be a link in the description, as well as you can scan the QR code if you're watching. Let's talk about the forecast. Analysts are optimistic about the company's new strategy. So there's 21 analysts covering the company, and they've got a 32% upside in their target price. Analyst consensus is bullish, with 90% of analysts issuing a buy recommendation. Only 2 analysts recommend hold. Consensus expects strong revenue prospects over the next 3 years. Let's look at the P&L for a moment. The strong bottom line is mainly driven by the heightened demand. So we can see net profit bouncing back, and demand is strong as the economy starts to recover from the government-led shutdowns. PTT is capital-intensive business, which means that more than 50% of total assets are net fixed assets, and it's going to probably remain that way for a long time. So the key to understanding this story is to understand the fixed asset investment. The global average is about 33%, so they're at about 57%. That just shows how capital-intensive the energy sector companies are. Let's look at long-term debt. Its aggressive expansion plan requires the issuance of further capital. Probably it's going to be some debt. And being state-owned, I don't expect the company to struggle to raise capital because they can raise it on the back of the credibility of the government. And here we can see the capital intensity. The revenue per 100 baht of assets is interesting. In 2019, the company generated 92 in revenue per 100 in assets. That collapsed down to 64 in revenue to 100 in assets in 2020, and I expect that it's going to start to recover to about 80 in revenue for every 100 in assets. And given that they're investing in new areas that are going to take time to get up and running, it could be that that number doesn't improve by much, and that's a driver of the ROE. Right now, I'm forecasting about a 12% return on equity. Not bad, but certainly not where it used to be in the past. Now, let's look at the gross profit margin. This type of business tends to have a very low gross profit margin because it's a lot of trading and also it's government related. So the gross margin fell to about 10% in 2020, and I'm expecting it's bouncing back in 2021 and 2022 to about 15% gross profit margin. Net margin is going to be about 4%. So let's look at the valuation. We're going to use the Stotz investment research stock picking checklist that I've created. It's inspired by Peter Lynch's 10 baggers, which is a stock that's gone up by 10 times. He talked about that in One Up on Wall Street, an amazing book. It's based upon our extensive research of 10 baggers, and there's 9 factors that drive long-term share price performance according to this research that we've done. And I'm going to review each one of those briefly. The first one is management. The question is, management has a proven commitment to growth. The potential here is strong. The management aims to expand in further industries to escape growth stagnation, and they have the power and the knowledge to do it. I'd say there's good potential. So the next question is growth. the product and industry can support a decade of 10+% annual growth. I would say moderate. The top line growth over time will likely normalize to maybe 5% or something like that, but I don't see that it's going to be huge growth coming in this company. I would say more steady. So it's not going to be huge growth. That's not a great signal. Now, sustainable, that's number 3. The competitive strategy creates sustainable high gross profit margin. This is weak. Gross profit margin is about 15 to 16% already at its peak, and there's no catalyst for further improvement. It's not like they're going to go into businesses that are going to drive that up. Next is number 4, quality. Good earnings quality, non-core items are small or non-existent. And in this case, I would say weak. Earnings fluctuate quite a lot given the industry's volatile nature. It is an energy company. It is the most volatile industry as far as price and quantity. Number 5 is efficiency. In the long run, sales grow faster than assets. This is also weak. The company has high CapEx required to meet its growth over the next few years, and so I expect that it's not going to be that efficient with its capital in the near term. Number 6 is tight. Relatively low cash conversion cycle. Negative is best. Here it's moderate. Cash conversion cycle is moderately high and stood at 41 days in 2020. Let's talk about cash flow. Operating cash flow is consistently positive. This is item number 7. This is good. PTT generates high operating cash flow and has no trouble covering the high investing outflows. This is good news because sometimes with a big cyclical business, it can affect the cash flow, but because they're pretty diversified across not only having some exposure to exploration, but also having gas distribution, they've got a lot of ability to diversify. Also, their exposure to chemicals and utilities is significant. Point number 8, the company has access to capital to fund its growth. Here is good. Being state-owned and the largest Thai company, basically, they got perfect access to capital. And finally, inexpensive. The valuation is reasonable, and it's very, we want to avoid a very expensive stock, and this is good. On a 2022 PE and price to book compared to Thai energy companies, it's cheap, and it's about in line when it comes to ROE. So not bad. Let's say that I think that there is a moderate chance that this could be a 10-bagger. I would say it's a moderate to low, but there is a little bit of potential there. But I wouldn't say that it's a clear 10-bagger from my perspective. Now let's look at the free cash flow. I expect rising CapEx in line with its strategy to realize further growth by investing in other industries, and I've put that into the forecasts, and we can see that that's a key element here. Also, let's talk about the forecast assumptions in the valuation estimate. Now, first of all, revenue growth, the average revenue growth that analysts are predicting is about 15%. I'm comfortable with that. The gross margin is about 16. I brought mine down to about 15.5. And then net margin comes out about the same at about 5%, which is pretty good for this type of company. So I'm roughly in line with the analysts. Engaging in new industry lines and M&A could justify a terminal growth rate of about 4%. So I'm a little bit going to put in a big number of 4% there in the terminal growth. So now let's just look at the value. What do I come up with? My base valuation is 48 baht. That's an upside of 26%. The bull case is 53 baht. That's an upside of 39%. And the bear case is an upside of 16%. So even in kind of my worst case, you could say there's still upside. So let's review the company's world-class benchmarking scorecard, where we identify a company's competitive position relative to global peers. We use a composite rank of profitability and growth called profitable growth. We look at a scale of 1, which is best, 10, which is worst. So let's take a look at PTT. Here we can see we're benchmarking against 310 large energy companies worldwide, and it is a solid average company. From a 5 to a 4 to a 6 to a 5, basically the company's profitable growth score is very solidly average. Now you may say, well, Andrew, but this is a very big company. How is it going to grow very fast? Well, remember, my benchmark is 310 large energy companies worldwide. So I am comparing against other large companies. So to say that it is not growing that fast or profitable growth is not going that well, I would say, yeah, this is a clear indication that it's got average profitable growth. As far as profitability is concerned, it's about average. And as far as EPS growth is concerned, it's about average, even slightly below, although it's improved in the past 12 months. So from a world-class benchmarking scorecard, this is an average company. Risks. The key risk is fluctuation in oil price. Depleting gas reserves are in question, and this questions longevity of its gas business. Also, engaging in new industries definitely is risky. They could overpay, or integration may not work. And then you have volatile commodity prices could pressure margins. So my conclusion at this point, the growing gas business and renewables drive some organic growth. PTT's expansion to other industries could still be value accretive, meaning adding to value, and the attractive dividend yield despite growing CapEx requirement. So now it's your turn. Let me ask you, is PTT's strategy to become a multi-industry conglomerate the right move? I look forward to your comments in the marks below.